Today, we're going to demystify the world of investing by diving into the basics: stocks, bonds, mutual funds, and ETFs. Whether you're just starting out or looking to sharpen your knowledge, this session is designed to help you feel informed and confident about these key investment vehicles. By the end of this video, you'll understand what these terms mean, how they work, and how they can fit into your financial journey. So let's get started. First things first, what is investing and what's the difference between investing and trading? At its core, investing is about putting your money to work to help it potentially grow. It's not just about saving, it's about creating opportunities for your money to increase in value over time. This may help you build wealth, achieve your financial goals, and prepare for the future. Now, it's important to note that investing involves risk, and that includes loss of principal. When you invest, you're essentially buying assets and taking risk for the potential to generate income or have some appreciation in value. Things like stocks, bonds, or mutual funds, ETFs, and real estate. These would be considered different classes of assets you might invest in. But how is it different than trading? It depends on how you're using that term trading. Now, if you're using it to refer to the act of selling or buying securities, then it's something you do often when you're investing. However, if you use it to refer to what a trader does, that is, a person who trades often, then there are two different strategies used with the goal of growing assets or making money. The key difference lies in your approach, your time frame, and your goals. The objective of investing is to build wealth over a longer period of time, while trading seeks to make short-term profits by frequently buying and selling assets like stocks, bonds, options, currencies, or ETFs. In order to work toward these objectives, people who are investing are typically considering fundamental values of companies or assets with an aim to benefit from growth or dividends and compounding interest. Traders rely more heavily on market trends, technical analysis, and timing to capitalize on price fluctuations. Investing is usually considered less risky because it emphasizes patience and long-term performance, while people who are focused on trading typically assume higher risk due to that fast-paced nature and dependency on short-term movements. In this video, we are focusing on investing and the longer-term approach. Now let's talk about some of the most common types of investments you'll come across: stocks, bonds, mutual funds, and ETFs. Stocks. Now, when you buy a stock, you're purchasing a small piece of ownership in a company, what's often referred to as a share. Think about some of your favorite companies. When you buy their stock, you become a part owner. If the company does well, the value of your shares could increase, and you might even receive dividends, which are a portion of the company's profits. However, stocks come with risk. Their value can go up and down, sometimes unpredictably, based on factors like market trends, company performance, or economic conditions. Stocks are considered higher risk investments, but they also have potential for higher returns over the long term. Bonds. Bonds, on the other hand, are like IOUs. When you buy a bond, you're basically lending money to a company or a government in exchange for regular interest payments plus the return of your principal when the bond matures. Bonds are generally considered less risky than stocks because they provide a fixed income and are less volatile. However, their returns are usually lower. For example, imagine lending money to a city to build a bridge. In return, you receive steady interest payments over a set period of time, and this is essentially how bonds work. Both stocks and bonds play important roles in a diversified portfolio. By combining them, you can balance risk and reward based on your financial goals and risk tolerance. Just remember, there is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Number 3 are mutual funds. These offer a way to diversify across a bucket of assets that's managed by professional fund managers who make investments on your behalf. It allows investors a way to diversify across a wide range of assets like stocks and bonds, with a smaller amount of money that is pooled with other investors. The beauty of mutual funds is that they allow you to invest in a wide range of assets without having to pick and choose each one yourself. Mutual funds are a popular choice for long term goals like retirement or college savings as they provide broad exposure to the market. ETFs, or exchange traded funds. Now, let's talk about ETFs. ETFs are similar to mutual funds in that they do pool investors' money to buy a diversified portfolio of assets. But here's the difference: ETFs are traded on stock exchanges just like individual stocks. This means you can buy and sell them throughout the trading day at market prices. It's also important to note the difference between active and passive management. Mutual funds are almost always actively managed. That means the fund managers actively research the investments and they make adjustments to holdings based on whether they meet certain criteria. ETFs, on the other hand, are often passively managed. They typically build a set of criteria for the investments to be qualified for inclusion, or they follow an index. This requires little, if any, management. As a result, ETFs often have lower fees than mutual funds due to their passive management style, and they can be a flexible way to invest in specific sectors, industries, or indexes. For example, you could invest in an ETF that tracks the S&P 500, giving you exposure to 500 of the largest companies in the US. Mutual funds often have a flexible asset allocation that can be adjusted based on market changes. So, how do you decide which of these options is right for you? Well, it all comes down to your financial goals, your timeline, and risk tolerance. If you're saving for something far in the future, like retirement, you might lean more toward stocks or mutual funds and ETFs for their growth potential. If you're looking for stability and steady income, bonds and bond funds could be a better fit. And if you want the benefits of diversification without the stress of picking individual investments, well, mutual funds and ETFs are an excellent choice. Remember, it's not about choosing just one. It's about building a well rounded portfolio that aligns with your needs. And here are the key takeaways to remember. Stocks offer growth potential, but come with higher risk. Bonds provide stability and income, but have lower returns. Mutual funds and ETFs give you diversification and convenience, with ETFs offering more trading flexibility and mutual funds more often giving you an actively managed diversified portfolio. Investing doesn't have to be overwhelming. Start small, stay consistent, and focus on your long term goals. With the right strategy and guidance, you can create a portfolio that works for you. If you're ready to take the next step or have questions about building your investment plan, I'd love to help. Reach out anytime. As a CFP professional and financial advisor with Milligan Wealth Management, I help my clients examine their financial goals and build portfolios that align with those goals. Find out more about how investing and goal setting can be aligned to your personal financial life by visiting my website at milliganwealth.com, where you can check out my blog on this topic along with tools, calculators, and other helpful videos. You can also schedule an appointment with me through my website. If you found this video helpful, don't forget to share it with others. And please subscribe to my Milligan Wealth YouTube channel for more insightful content on financial planning. Thanks for watching, and here's to your financial success. I'm Bud Milligan, your financial bud.